If you are a financial investor and not already in India, you should ask yourself why. India is one of the most compelling financial investment destinations in the world today. But the playbook is different here. The challenges for financial investors are real and specific. The contracts look similar. The enforcement reality sadly does not. The investors who succeed understand India on its own terms, not through the lens of markets they already know. Hello and welcome back to the Veyrah Law series. In our episodes so far, we discussed strategic investments, setting up operations, joint ventures, manufacturing, or a brand presence. Today, we shift the lens. This episode is for financial investors, entities deploying capital into unlisted Indian businesses without running them directly. Essentially, private equity, venture capital, family offices, and institutional players. As always, before we start, please read the disclaimers carefully. With that done, let us start with why India deserves serious attention from every financial investor. If you are a financial investor and not already in India, you should ask yourself why. India is the fastest growing major economy in the world. GDP growth above 6 to 7% consistently, projected to be the world's third largest economy in the foreseeable future. Private equity and venture capital investments reached $60.7 billion in 2025. The Nifty 50 index has delivered annualized returns of approximately 11% in dollar terms over a 10-year horizon. Exits have been strong. Landmark IPOs, Zomato, Nykaa, Policybazaar, and the likes generated significant returns for early investors. The exit environment has never been more active, but the challenges for financial investors are real and specific. Contract enforcement is the first. Enforcing put options, drag right, or indemnity claims through Indian courts is slow, uncertain, and quite frankly, a futile exercise. Exit pricing constraints are the second. RBI pricing guidelines on share transfers can restrict exit options in ways Western investors may not anticipate. Tax uncertainty is the third. GAAR, treaty benefit uncertainty, and capital gains treatment can all shift at exit. Currency depreciation is the fourth. The rupee depreciates approximately 2 to 3% against the dollar annually. Strong rupee returns can look different in dollars. And one point that surprises many, assured returns for foreign equity investors are not permissible under Indian law. Structures that attempt this risk being recharacterized as debt with very different consequences. So what should financial investors actually do? India is genuinely compelling for a financial investor, but it requires a different mindset from Western markets. The contracts look similar. The enforcement reality sadly does not. Here are some recommendations to deal with this reality. First, diligence, and then more diligence. In Indian private equity and venture capital, diligence should not be a box to tick. It is your primary protection. Diligence the asset, diligence the promoter, diligence the business model, check court records, regulatory filings, related party history. In India, the promoter's quality is often the single most important determinant of outcome. Second, accept the reality of contract enforcement. This is a hard truth. A deal gone sour in India is largely a written-off deal. Enforcing put options or drag rights in court is slow, expensive, and uncertain. Your legal protections are tools for negotiation, not reliable enforcement. Invest your negotiating energy instead in operational protections, governance rights, information rights, veto powers over key decisions. Third, govern operationally, not just contractually. Your best protection is ongoing oversight, timely audited financials, monthly management accounts, bank statement access, real-time visibility on cash and related party transactions. Problems in Indian portfolio companies build slowly. Early information lets you intervene early. But be careful. In high corruption sectors like real estate or infrastructure, too much information on how approvals are obtained can expose you to liability. Focus on financial performance and compliance metrics, not on government interface details. Fourth, avoid directorships. Stay at observer level. Being a director of an Indian company carries real personal liability, tax defaults, regulatory violations, environmental breaches, labor law non-compliance. Observer status gives you the information you need without the legal exposure. If a board seat is necessary, ensure your nominee director has robust indemnity protection and understands the personal risks. Fifth, Western concepts do not always translate. Many investors arrive with term sheets built for Western markets. Liquidation preferences are enforceable in theory, but practical enforcement in an Indian court is debatable. Drag-along rights, recognized, but enforcement requires careful Indian law drafting. Non-competes, generally not enforceable post-employment in India. Work with advisors who know both international deal standards and Indian law. Do not import a Western term sheet and assume it holds. This concept in itself is a topic for a detailed discussion. Lastly, structure with substance and price in currency risk. India's GAAR rules are real. As the Tiger Global judgment confirmed, paper structures without genuine substance will be challenged. Treaty benefits through Mauritius or Singapore are available, but only with genuine presence, real board decisions, and a credible business rationale. And price in currency risk. The rupee depreciates over time. Keep in mind your USD returns, not just rupee returns. Factor exit tax cost into your model at the start, not when you're trying to leave. To sum up, India is one of the most compelling financial investment destinations in the world today. Fastest growing major economy, deep and liquid public markets, a maturing private equity and venture capital ecosystem. Exit routes more active than ever before. But the playbook is different here. Diligence harder, govern operationally, stay off the board, structure with substance, price in currency risk. The investors who succeed understand India on its own terms, not through the lens of markets they already know. As the late Charlie Munger observed, invert, always invert. Turn a situation or problem upside down, look at it backwards. In India, the investor who inverts the question by asking how to pick the right partner rather than how to enforce their rights against the partner, that investor will do very well. We hope this episode has given a useful framework for a first-time financial investor in India. If you found this video useful, please do share it. Thank you for watching and see you in the next episode.